My friend, is there anyone who's still struggling to make money from trading? I have a gift for you. This is New Year. Today, I will teach you best ICT liquidity sweep strategy that you can use from today henceforth, 2025 and beyond. This is very easy and straightforward strategy. It makes use of 5 steps. So, listing the 5 steps, we are going to make use of buyers. I will teach you how to identify correct buyers without guessing twice. Second step is using daily open of the candle. Third is marking out the recent liquidity levels. Fourth, liquidity sweep. I will teach you how to identify areas price is likely to target before moving to the origin direction. The last one is entry model. Then I will share one or two examples before I end the video. So stay tuned. So how do we identify our buyers? Pay very good attention. Make sure you watch this video to the end to see how we put everything together in order to have all the information to make money from Forex in the year 2025 and beyond. There are many ways to identify buyers, which most of you have watched numerous videos on YouTube, and you can do that better than me. But I have a very simple way to do that. But before we go into on how I identify my buyers, remember what I always say. You need to understand what is the market condition, that's the market structure at the moment. Now we have seen that price was in uptrend. Identifying our buyers can only be in this internal range liquidity and this external range liquidity, or in expansion phase of the market. That's where we can be able to identify our buyers. On those key areas is where you have high probability trades. You understand? So if you can be able to identify the structure and the internal range liquidity, are we in external range, at least solve the 50% of a problem. I hope I'm making sense. So now, hadn't been, you wake up in the morning and the price, you meet price in this zone. Now let me show you how I do that. I use three candle formula. I call it three candle formula. If the first day is bearish, the second day is bearish, we're anticipating that the third day will be bearish, and you see it happens here, right? Market changes. We won this trade if we take this action here. Then we count again. The first day candle, this is the first day candle, second day candle. So we anticipate that price will continue bearish, but price failed to do that. As price failed to do that, our counting will start from here. This will be your first day candle, and your second day candle failed to close below this candle, right? It closed bullish, so we're anticipating that next day will be bullish, and you see it happens here, right? It will not be 100% accurate all the time, because as you can see here, the first day candle closes bullish, the second day closes bearish, and the third day price was bullish. I hope I'm making sense. Now, if price was bullish the third day, is you start counting from that very day. I see that price was bullish this day. It was bullish first day candle, second day candle, and this is your third day candle. I see as a bullish. Then this is the first day, second day, third day candle as well. We are in uptrend, and the price moves from this zone to this zone. Look at what happened here. We have engulfing bar, and we count. This is the first day candle. This is our first day candle. Second day candle was bearish, and the third day we're anticipating price will be bearish as well. That's how it works. Let me show you another example. Price the day closed inside this candle, nothing happens. The other day price was bullish. We started our counting here. First day candle, second day candle. We're anticipating that the third day candle will be bullish, and you see it happens. Here becomes our first day candle, second day candle, and the third day we're anticipating the price will be bullish, and it is bullish as well. This is how to do that, but it must be in a kill zone, as simple as that, guys. So let me move to the second step. So guys, in this very diagram, we're going to explain number 2, 3 to 5. We have to take everything here, so pay very good attention. Now let's assume we have price moving uptrend, like we have a price in uptrend and we are in expansion phase, and we spot a candle which is bullish, first one, second one, which we are now anticipating that next day is definitely got to be bullish as well. So what's the first thing we do after identification of our structure and buyers? The next thing is to mark the opening day of the candle, and you have to agree with me that where the last candle closes is where the other candle will open. So let's assume this candle close and we have another day. If you're using New York time, the opening of daily candle starts from 1845, which is the Asian section. So we have marked the opening of the candle. What next we do here is to mark liquidity, that is recent swing low. And explaining this very candle in a diagram, what we have in this very diagram is something of this nature. We got to have a diagram like this. Got to have a diagram of this nature. Price, we form this type of move, and immediately it's come back. That's what we see in 15 minutes time frame. After the opening of the day, we have mark out the opening of the day. The next thing we have to mark is recent liquidity level, which will be, is not on the current price action. So let me take this out. You will mark it in the old price action, which is this candle. We are representing this candle with this line. So this is liquidity level. This is recent liquidity level. We have to mark it out because that's what we are waiting for price to sweep. So these are liquidity levels. This is daily time frame, and each replication 15 minutes time frame. That's how it looks like in the previous day. So we have to mark the previous day price action because we have our opening here. This is the opening of the day. As we have marked that, we're expecting price to do what? We're expecting price to come in and sweep liquidity. It's either here or here. Any liquidity swept. Once that liquidity is swept out, the next thing we're looking for is market structure shift, and our market structure shift will be in this nature. We need to have a pullback and price will create lower high, and if you fail to close below, that is another additional confluence. Once price take up this recent lower high created, is going to leave us with a fair value gap. So once price leave us with a fair value gap or other block, anyone we spot there, we take our entry inside the AVG or other block, and the target 1:2 or 1:3. I hope this is clear. I know it's not that much better, but at least with this schematic diagram, you have understand what you are looking on a live chart. Maybe when we move into live example, you will understand it better. So the same thing on either side. So let me reverse this chart. So the same thing if price was bearish. If price was bearish and you spot a bearish candle in the expansion phase, the first candle, second candle, which you are anticipating that next day got to be bearish as well, and this is the representation of this candle. You mark the liquidity zones that price will take out on the opening of another day. Once price take it out, you look for what? You look for market structure shift, which happens here. We have a market structure shift here, and if there is any fair value gap or other block, you take your entry and target 1:2. This is what you'll be looking for every day, every single day. This works in every pair, and that's simple as that. So let me take you on live example, then I'll end this video. So guys, pay very good attention. This is the first example and it might be the last. How do we start? We start by defining the market structure, and if you look closely, you understand the market was in uptrend. All of a sudden, price moved down to this spot, this very spot, and they failed to create another higher high. So technically, market have changed direction. We are in downtrend. This is current example on US 30, 2nd January. So pay very good attention. As we have defined the structure of the market that we are in downtrend, let's check out our buyers. As we always say, the way we define our buyers from what I illustrate on those diagrams. This is the first candle and this is the second candle. The next day, which is 2nd January 2025, we're anticipating that price will continue bearish. This is on US 30. So now that I've known my bias, the next thing I have to do is to mark the opening day of the candle. And we all agree that where the previous day candle closes is where another day candle will open, right? Unless it's a fresh week. So now we have, let's mark out the opening of the candle. I'm just trying to show you how everything will be, but we are marking the opening day of the candle on 15 minutes time frame for we to get the exact zone, the exact place the candle open. But I'm just using this as a framework. Price opens every day at 18:45 New York time. So where is our 18:45? 18:45 at this is 16:45. This is opening day of the candle. Exactly, I got it right. So now we have known that the price was in downtrend, that our bias is bearish. Here is what? Where is the liquidity that we have? This is the previous day high, lower high, right? This is another. Is there another pullback here? We have another pullback here, another pullback, valid pullback, and the extreme high we have is in the zone. So price is free to travel from this end to this end. Is not our concern. All what matters to us is price to take liquidity and change structure, and that's what we have here. Price take out liquidity here, move, and we have market structure shift. This is our market structure shift. We have a market structure shift here, and there's a fair value gap inside the zone. There's a fair value gap, but for me to use that, I have to use this other block because it's closed. And you can see how price went in and do what? Tap into this other block. And if we target 1:2, this is where our take profit will be. Always target 1:2. But if you're somebody who have confidence, with time, if you start using this strategy, you can go more of 1:3 for you to save your losing days. So that's how it works. So let me repeat myself because I'm not gonna give another example. Our bias, our structure is bearish, and the bias is bearish. We mark the opening day candle because the previous day was bearish. Now we have marked liquidity on those previous day. This is the previous day. Let me use my open close time vertical line indicator. You can see that this is the opening, this is the previous day, this is the high, and this is the lower high. All these things are liquidity. We are expecting price to run out those liquidity and give us market structure shift before it will move down to its original direction. If you are still struggling to make money, use this strategy. I'm not gonna give more. If you don't practice, I don't think you got to make it in this industry. So what I give you, I try my possible best to illustrate better, though my English was not okay for those of you who think I'm not speaking well, but at least I try my possible best to do the technical art, right? So everything I explain here, just go in there, practice, and back test. In my maybe next video, I will show you guys who don't have money to pay for TradingView. I will show you a platform for you to back test your strategy, practice every time. Because if you don't back test, you won't have confidence to take those trades, right? I take this trade today. I take this. I win around 4 trades today using this strategy. So if you can use it, better for you. If you still want to keep hopping from one channel to the other looking for strategies, you're just wasting your time. Make sure you stop everything you're doing in this 2025 and focus on this strategy. Peace. See you in my next video. Don't forget to subscribe, share with your friends who are still struggling. All I'm doing here is just to help out, nothing more, nothing less. Peace.